Hello traders, welcome back once again. In the previous episode, we covered two powerful reversal patterns, the double top and double bottom, where we learned how to identify them, how to confirm valid breakouts, and how to plan precise entries, stop losses, and targets. Now in this episode, we'll move one step ahead and talk about the triple top and triple bottom patterns. These patterns are simply advanced versions of the double top and bottom, and once you understand their structure and psychology, you'll know exactly how to catch stronger reversal moves in the market. But if you haven't watched my previous episode yet, click the I button above and check it out first, so you can connect the full concept clearly before moving ahead. If you've understood the double top and double bottom patterns properly, then the triple top is going to be a piece of cake for you, because this pattern is nothing but an extension of the double top. The logic, entry, and trade management stay the same, but this time, the pattern adds one extra layer of confirmation, a third rejection from resistance. A triple top is a bearish reversal chart pattern that signals a shift in market control from buyers to sellers. The formation begins with buyers pushing the price higher to create the first swing high, followed by a pullback. Price again moves up to form the second high, but fails to break above the previous one, giving us our first sign of selling pressure. After this, the market consolidates again and makes one more attempt to push higher. But this time too, buyers fail to sustain above that resistance, and price rejects from the same area once again. Now we have three clear rejections from the same resistance zone, and this forms what we call a triple top. The pattern is officially confirmed only when the neckline support, or the low of the consolidation, is broken decisively. Now let's talk about the most important part, how to trade the triple top pattern effectively, just like professional traders do. There are three possible ways to enter a trade. 1. Aggressive entry. Enter as soon as the price breaks below the neckline. This gives you the earliest entry, but it comes with higher risk because false breakouts can happen. 2. Build-up entry. Wait for a small consolidation or buildup just below the neckline. Once the price breaks down from that buildup, you enter short. This entry has a tighter stop loss and a much better reward to risk ratio. 3. Pullback or retest entry. If you miss the breakout, wait for a pullback or retest of the neckline after the breakdown. When the price retests the neckline and starts rejecting again, that's your signal to enter short. Your stop loss will depend on your entry style. For aggressive entries, place your stop loss just above the last swing high, or a few pips above the neckline using an ATR buffer. For build-up entries, place your stop just above the build-up structure or small consolidation zone. For retest entries, place your stop just above the highest wick of the retest candles. This ensures that even if there's a small fake out, your stop loss won't get hit unnecessarily. There are three methods to set your targets. 1. Price projection method. Measure the distance from the neckline to the highest swing top. Then, project this same distance downward from the neckline. The projected level will act as your take profit target. 2. Trailing stop loss method. If you want to ride big moves, use moving averages to trail your stop loss. For short-term trends, use the 20-period moving average. For medium-term trends, the 50-period moving average. And for long-term trends, the 200-period moving average. Exit when the price crosses above your chosen moving average. 3. Combination method. Take partial profits at the price projection target and let the rest of the position run using a trailing stop loss. This way, you lock in some profits while keeping the potential to catch a longer trend move. But remember, no pattern, strategy, or technique works all the time. Even the triple top can fail, especially when it forms against the higher time frame trend. For instance, if the higher time frame is still in an uptrend, the triple top on a lower time frame is likely to fail. So always use multi-time frame analysis, identify higher time frame resistance zones, and then trade the triple top on a lower time frame that aligns with that structure. Now let's talk about the triple bottom pattern, which is just the opposite of the triple top. It's a bullish reversal chart pattern that indicates buyers are regaining control. The pattern starts with sellers driving prices down to form a swing low, followed by a pullback. Then, as the price tests the same level again and fails to break lower, we see the first signs of buying strength. The market consolidates, forming a structure similar to a double bottom. However, instead of breaking above the neckline immediately, the price tests the support level once again, fails to break the low, and then starts moving higher. Now, we have 3 visible lows, or 3 failed attempts to push lower. This confirms a triple bottom when the price breaks above the neckline resistance. The entry, stop loss, and target rules are exactly the same as we discussed in the double bottom pattern. So, if you're new or want a refresh, you can refer back to episode 2 of this series where I explain double tops and bottoms in detail. So that wraps up the triple top and triple bottom patterns, 2 of the most reliable reversal formations in technical analysis. In the next episode, we'll dive into the world of wedge patterns, a powerful setup that often gives traders early signs of reversals before they happen. If you found value in this video, make sure to hit the like button, share it with your trading friends, and subscribe to Time to Grow so you never miss any part of this chart pattern series.